Welcome to hackertrading.com. My name is Hari Swaminathan. In this video, we're going to study what credit spreads and debit spreads are. So now we are reaching the intermediate level of option strategies. And even though these spreads are considered to be intermediate strategies, these spreads actually represent the centerpiece of all option strategies. So you'll find that spreads are a very comfortable zone to work with. And especially if you're working professionals, you'll find that credit spreads could be a very nice strategy for you, as well as debit spreads also. So now here we're looking at Apple, and the symbol for Apple is AAPL. And what we want to do is we want to see what a credit spread is and what a debit spread is. So here we're looking at the July series, which has about 24 days to expiry. And Apple's currently trading at 570. So your 570 call, you have your calls on the left hand side. So your 570 call and the 570 put are the at the money options. So if you were bullish on Apple, what you could do is create a bull call spread. So a bull call spread is a vertical spread, and you would buy the spread. So if we come here, we can look at this is a bull call spread. So if Apple is at 570, then you're buying 10 contracts of the 570 call, and you're selling 10 contracts of the 575 call, which is slightly out of the money. So you can see that the 575 call is slightly out of the money. So now what is the definition of at the money, out of the money, in the money? All of this is obviously explained in detail in module 2. But once you've gone through that, you can understand what these spreads are all about. So in this case, if we look at the risk profile of this debit spread, what we have is this. So what it does is it reduces our loss exposure, it caps it, and on the upside, it caps our profit as well. So we give up this profit on the upside, but in return, we get to minimize or reduce our losses. So that's what a bull call spread does. It's still a bullish strategy. You can see that the white line is moving towards the top right. So it's still a bullish strategy. But what it does is it controls your position in terms of two things: in terms of your risk exposure on the downside, and what it does is it reduces your capital allocation on this particular position. So on this particular position, you have a buying power effect of $2,450, and your maximum profit, which is shown in by this red line right here, is $2,570. You can see that from this number right here. That's your maximum profit of $2,570. So a bull call spread is great if you have a mildly bullish outlook on a stock. If you feel Apple's going to go up by about $5 to $10 from where it's currently trading at 570. And if you feel it's going to go up by about $5 to $10, you can go in for a bull call spread, and this will let you have your bullish outlook. And at the same time, if you were wrong, you're able to control or reduce your losses. Rather than if you were just to buy a straight out call option, you'll be facing a much more bigger loss if you were wrong. But by converting it to a spread, you're reducing your losses. Now, what you could also do is a credit spread. So in a credit spread, you are assuming the profile of an option seller. So there's a huge difference between the profile of an option buyer and the profile of an option seller. So it's very important that you go through all those courses in module 2, because we take you one step at a time and we explain all these details there. So it's very important to know whether you want to be a buyer of an option or a spread, or you want to be a seller, because the two strategies are completely different. Because if you're a seller, you wouldn't want to do at the money options. You wouldn't want to put a spread at the money. You want to go out of the money and you want to keep probability on your side. So there's a big difference between a bull call spread and a bear call spread. So if you were a seller of this spread, for example, that's what your profit and loss graph would look like, because now you're it's a bearish position because you make profits as the stock goes down, and if the stock goes up, then you're going to see losses. But if you were to put a bear call spread, you wouldn't put it at the money, because now you want to put it out of the money. You want to put probability on your side. So there are various factors that come into play, and it's hard to explain in a short video all the different parameters that you have to look at. And that's why we explain all of these details in various courses, and within those courses, we've got everything divided into chapters as well. So module 2 is critical to understand these basic differences, fundamental differences between a buyer's profile and a seller's profile. But if you were to have a bear call spread, then this is what you would do. Your maximum profit again would be 2,400 and your maximum loss would be 2,550. But the fundamental principle of a spread is that it controls your risk if your position is going against you, and in return, it also caps your profit. So it's a compromise that you make when you're putting a spread on. It's a compromise, and most of the time, that compromise is well worth it, because you know exactly what your risk is and what your reward is. So you can see these are flat lines on the reward side as well as the risk side. So you know exactly what your position can win or what your position can lose. And this kind of a position is called a defined risk and defined reward position. And for most option traders, especially if you're a beginner or even at an intermediate stage, you want to put on defined risk and defined reward positions. And that's what spreads does. This is spreads are covered in detail in module 4. So module 4 introduces spreads, and we look at all 4 spreads: the bull call spread, the bear call spread, the bull put spread, and the bear put spread. And all 4 have different characteristics, and you need to know when to put each of these spreads. And we'll cover all those criteria as well. So that's as far as the credit and debit spreads goes. Thanks for watching this video, and I'll see you in the next one.